everybody. Welcome to the Mills team discussion today. We're joined with Sarah O'Neill and Lauren Rebecca, Sue Mills, Christine Sweeney, and I'm Katie Mills. And we have our very special guest today, Alec Basso, and he is from Greybrook, which is a private equity firm. And he's going to tell us about how they invest in large-scale real estate. Welcome.
Yeah, thank you so much for having me. Appreciate it. We were talking earlier, I've never been to Don Mills, and I'm like, this is insane. There's a lot of stuff going on here. This is a real place.
It is amazing. It's amazing.
The first subdivision in Toronto.
I grew up in Etobicoke, and then all the Midtown people tell me that Etobicoke is not in Toronto, and I'm like, it very much is.
It's
in Toronto. My cell phone number is 416. So appreciate you guys having me here. It's always a lot of fun, going out to different places and talking about what we do. It's for a lot of people, they're aware of it, but investing in real estate it's conventionally buying your own house, and it's maybe buying a pre-construction condo. So this is an alternative passive form of investing. The passive word gets thrown around a lot. If you're buying a single family home, duplexing it is a big thing right now. That's very much not passive. Our form of investing is very passive because you're allocating capital to our product and to our team, and we are then stewards of capital in kind of orchestrating the development and what we do in the long term. So very much long-term investing, but very much passive. So it works for a lot of people's portfolios. So I just want to take you through an introduction as to what we do, and then we can kind of open up the floor to a few questions. There is a lot here, so it's a lot to digest, but I'm always happy to chat with people externally and offline. So why don't we get into it right now then?
Good. We're excited to learn all about it.
Yeah, for sure. Okay, so Greybrook is a private equity company, and what we do is we invest in residential development. So we don't do office, we don't do industrial, we do a bit of commercial, but that's more so allocating a portion of our project to commercial, retail. That's conventionally your bottom of your or your floor of your condo site. What we do more so is the conventional housing, single family homes, stacked towns, back-to-backs, is your low-rise master plan communities. And then we do high-rise condos. We typically focus in Southern Ontario. The reason being is we like the fundamentals. There's always talk about immigration, diverse employment, all that kind of stuff. So we see that more so in Southern Ontario than any place in Canada. There's a lot of people that invest in Calgary and Edmonton. Not to say that those markets aren't good investments, because I think they are typically, but those type of markets are a little bit focused on one or two industries. So we like Southern Ontario from a thesis perspective, just because it gives us that long-term price stabilization, so to speak. So Greybrook as a whole, we invest in residential development. We have about 100 active or completed projects. It's a lot. We see a lot. We do a lot. And that's over a span of 20 years. So it's relatively experienced in Southern Ontario. And then we have select US markets as well. So overall, it's about $30 billion in estimated completion value. And then about $2 billion in invested equity. And that's about 30% institutional capital. And about the remainder is just retail, everyday investors, which is great, just getting people involved outside of institutions. So this slide is basically going through where we are on a North American map. So like I said, we invest in Canada. We do have a portion of our properties are in Montreal. We don't do any ground up new development in Montreal. What we do there is a value add program. So we buy existing apartment buildings, we take them through a renovation process, and then we eventually liquidate that product. It's not a big portion of our portfolio. Most of what we do is new development. We don't do anything outside of Montreal and Houston in the value add space, but we're kind of looking more in the US for this type of product as well, kind of moving forward. In Canada, like I said, Southern Ontario is where we have primarily most of our projects, low rise and high rise. And that's by design. And then you kind of see on this map, we have a lot in Miami and Fort Lauderdale, Atlanta, Nashville, Denver, and Houston. And that's just kind of different types of products. We do multifamily rental ground up. I won't get into that. It's a little bit more complicated, but those projects have been fairly profitable in the kind of 5 to 6 year range. So And then we have a couple projects in Miami as well. So kind of dating back to 2015, now Miami's a huge market. So we were kind of getting in there a little bit early on. So this is just a kind of picture of our active Canadian portfolio. 138 Yorkville is a luxury high rise that's going through construction right now. I think average price of a unit there is like $6 to $8 million. So very different type of product. But like I said, retail investors getting into that type of product is always something good for a portfolio. Project in Fergus, that's kind of a 20-year deal. So very long term, but pretty good returns from an overall perspective, but a long term nonetheless. But that's going through construction right now. The Way in Mississauga is kind of going through construction. Garrison Point, which is your Liberty Village project, that's completed recently. I think there was maybe a couple dollars per unit was held back for carry-on warranties, but essentially complete. Stockyards, which is your Junction area, that project is complete. It's our third project, our first project of 3 in the Junction. And then Richmond Hill is kind of going through servicing right now. So it's just kind of a little snapshot. US portfolio, you'll see the Waldorf Astoria there on the right side of the screen. That's a 100-story high-rise, largest high-rise south of Manhattan. So we're in a project with Property Markets Group, PMG. They're a large developer in the US, and we primarily use them for our US projects. Yeah, so it's an interesting project. About 80% sold right now, so it's under construction after a long period of time. So, but definitely an amazing structure for sure. And then we have our society projects, which is the multifamily rental ground up build that we do in the US. So, all kind of interesting stuff there. With regards to our investment philosophy, I think this is always important for people to grasp and people to understand, because you build your thesis based on long-term investing. We invest in real estate. It's not, some people invest in a speculative approach. We do more so in investing in our philosophy and our thesis that makes sense from a fundamental perspective. So kind of in your top right, you want to look at optimal opportunities from a micro perspective, investing in the right product at the right time. But what you really want to focus on is getting that market selection right. Picking the right markets for the right reasons, whether they be for lack of supply, increased demand, which is typically what creates scarcity in housing, which creates stable and predictable price per square foot and essentially revenue at that point. We do want to pick the right execution partner. That's the benefit. And I'll go kind of into depth about this in a later slide, but right execution partner is long-standing developers that are well-known in the industry, that have been there for a long time, that are large to kind of capitalize on economies of scale, being able to get trades, good credit, all that kind of stuff. So partners that, and I think this is true now more than ever, to be able to get the right execution partner that we've had relationships with, 10 to 14 projects in the last 10 years. Because I think you're probably going to see, or maybe at the tip of the iceberg for small to medium-sized developers that don't have the access to trades, or have less of access to trades, and maybe the credits have tightened. The banks are starting to tighten a little bit. So those projects might be in a position where they're no longer viable. Whereas if you're investing with our expertise and with a developer partners that's substantial in size, they're able to withstand periods of uncertainty. So, and then the last part is just active asset management. We're not aggregators of capital in a sense that we do aggregate capital, but we're not giving it to a developer and then saying, see you in 6 or 7 years, give us reporting every semi-annual basis, and we'll see you in 6 or 7 years. We manage these assets on a daily basis in joint partnership with the developer. So that's just a creation of a partnership over time. Like I said, 10 to 14 projects per developer partner. So a lot of familiarity there. So why are the right developer partners so important? This is kind of a list of all the developer partners that we have. First Capital is a publicly traded company, but you're probably familiar with some of these names: Marlin Spring, Tribute, Treasure Hill, Stafford. So long-standing partners for us. And we kind of go through these different reasons as to why. I've kind of gone through the experience, but when we started, we didn't want to necessarily be in a position where we were giving money to someone that necessarily needed the money. So it's kind of a complicated approach, but basically, since we're aggregating 80 to 85 to 90% of the equity needed for a project, the developer partner is putting up, 10, 15, 20%, and the profit split is essentially going to be 50-50. Most people would say, well, why are you doing that? The reason being is we provide the developer with a huge advantage. They're able to scale their projects and be able to be in an equity position where they can diversify across different product types, as opposed to having all their capital in one project. But it also works from an investor perspective, retail investor perspective, because you're able to get into a project, but also these companies, based on their balance sheet, they're able to guarantee the loan. So much like maybe your kid buys a condo and you're the guarantor because maybe they don't have the income to qualify. So much like that scenario, these developer partners are guaranteeing $150, $300 million construction loans. So they're taking all the financial risk. So they need to be compensated accordingly. It's a good position for investors because as the guarantor, if any capital needs to be put up in order to make the project viable, we're not capital called as investors or as Greybrook. That's on the developer partner to take the project through to fruition. And that's just the benefit of partnering with big developer partners. They have the capacity to do so. So they don't necessarily need our money, but they're in a position where it works for them and it works for investors from a risk perspective. And then just economies of scale, especially in times like this, you're able to access trades, strong loans at competitive rates, as opposed to being maybe a high risk borrower from a bank perspective. They wouldn't be in a position to be able to do that. So kind of partnering with big developer partners is a huge competitive advantage for an investor. You can never really knock on a developer partner's door and be like, hey, I have 25,000. I'd want to invest with you. It's just not something that's doable unless you're at a family and friends event or whatever it is. So this slide is honestly probably the most interesting slide as to what we do and the value that we create. So how does it all work from an investing perspective? We operate in 3 stages. So, some people come to me, mostly on a daily basis, and they ask me, do you have any 1 to 2 year projects? The reason is, I always say no. And the reason is you can't really get anything substantially done in the space that we operate in 1 to 2 years. But from an investment perspective, you don't want to really be looking in that period of time, just because you leave yourself to a lot of risk. I think a lot of people made a lot of money in flipping houses, but you're making a lot of money because you're assuming a lot of risk. Whereas if you're in a long-term project, this could create more stabilized risk, but with more stabilized return and potentially more upside. So we typically see the longer the project, the more stable it is, because we're creating value in 3 separate stages. So in kind of stage 1, you'll see we operate in the white belt land. It's not common. White belt land is essentially, it's not green belt, but it's not deemed residential yet. So it's kind of in a little bit of a limbo stage. So what we did, a project that we have at Major Mac and Markham Road, it's about 50 acres we bought last year. It was in the white belt land. So it's not technically in the urban boundary, but it was abutting properties. It was enclosed by developers. So you knew at some point this project, from an urban expansion perspective, this project would have been allocated as residential at some point. So it's a little bit more risk in this stage, but we take the risk in a calculated approach where we know that this is eventually going to be put into the urban boundary and be deemed residential. We're not going out there and buying farmland and kind of flipping a coin and saying, oh, well, hopefully things turn out okay. The second stage is where we do most of our work. This is where we're buying land that's deemed residential, but it has to go through a rezoning application, municipal approvals, sometimes 3 to 4 to 5 years. And this is kind of where you're creating additional value as well, because you're buying land, you're doing the work to get it to where it needs to go from a density perspective, and then you're going through sales and marketing and construction accordingly. And then the last stage is where we'll buy some sites that are approved, and we've done so in the past, where it's just a manufacturing margin. So like I said, you're kind of buying a widget, or you're creating a widget, sell it for $100. Your input cost is 80 for the land and soft costs and all that kind of stuff. And then your margin is whatever it is. If there's a scenario where, it's topical now, but maybe a 5-year period where revenue flatlines. I don't suspect that's going to happen, but say it is, for argument's sake. There's a period of time where in that 5 years, people won't be creating housing because the numbers don't work. Your costs are too high. Your revenues, you're not creating that margin. So if you're not selling homes, you're not creating homes, the cost of those trades, the cost of those materials is kind of going to go down, and that creates a margin again. So in our model, we're not assuming perpetual price increases and saying, okay, these price for this product is going to keep going up and consistently going up, and I'm always going to have a margin. We are just looking for a margin because we're in the manufacturing business at this point in time, in this sales and construction stage. That's all we're looking for. If we need to hold off for a year and a half, we're usually well capitalized from a debt perspective that we don't necessarily need to go and launch sales and continue the project. So we're just looking for a margin in the end, which at some point there is going to be some sort of creation of a margin. So 3 stages of kind of the development and where we operate.
And I am sure you're going to get to the type of returns that your retail investors are experiencing.
Yeah, for sure. Also, I'll roll through these last slides, and then I'll get to an example, and then we can go with questions. So our fundamental thesis is based on demand and supply, or supply and demand. Fundamentally, from an Ontario perspective, that's why we invest in Southern Ontario, is the consistent demand from immigration and diverse workforce. You don't necessarily just rely on immigration, even though it's a big portion of our thesis, but you want to see diverse workforces. So the demand is consistent. The reason being is I don't think you'll see a point where immigration doesn't become a thing. From a productivity perspective in Canada, you need to have immigration. There's a lot of people retiring, people having less kids. You need to bring people in for us to compete on a world stage. So from an immigration perspective, you're probably going to see 400 to 500,000 people per year. And 40 to 50% are going to come to the GTA or Greater Golden Horseshoe, which kind of supports our thesis in the long term. So that's why we invest in that kind of fundamental thesis in the long term. From a supply perspective, this kind of chart just goes over the immigration targets. In 2020, you saw a regression for people coming in, and then you've kind of just seen an explosion thereafter. So that demand will consistently be there, and you see that right now where people aren't buying product, but they're renting. So it's kind of obvious that demand is there for some sort of housing product. This is just a kind of a few charts about supply constraints. So on the top left, you've got the green belt. In gray, you can kind of see where you can build. It's sort of a Manhattanization of Southern, kind of the GTA, Greater Golden Horseshoe. It's a huge topic now because it's highly contested. There's been a lot of discussions about, lands going in, lands coming out. The overall argument is we need to build housing, but having these restrictions from a legislative perspective, Greenbelt is very much an environmental thing, but it's also a thing because we have to, logistically, urban sprawl is not sustainable from a growth perspective. So infrastructure-wise, it costs a lot of money to expand the urban boundary. So that's why we need intensification. So that's essentially, the Greenbelt is environmental, but it's also a cost. So you need to be able to keep things in the urban boundary, expand it periodically, but you need to be able to intensify in those areas, because creating schools, fire stations, pipes, sewage, all that kind of stuff costs a lot of money. So that's why the green belt's essentially created, is to kind of create intensification in this area. So you have supply, or you have legislative constraints from a land perspective. You have approval timelines. When you create intensification, it usually has implications with it. People get upset if you're trying to create a large condo near their backyard, all that kind of stuff. We all know about kind of not in my backyard and that NIMBYism. But it very much is a thing to create stable price and predictable price. So, and then lastly, if you were to expand the urban boundary to forever up to Sudbury or wherever you want it to go, and you were to say, okay, everybody just build whenever you want, wherever you want, you still don't have enough construction workers to be able to do that. We're very much a knowledge-based economy. And we've kind of neglected those trades. And you're not essentially not able to produce housing in a timely fashion. So that is pretty much the presentation. I kind of just wanted to roll through a quick overview of a project that we have or had at this point in time, our most recent equity raise. So it's product on the Queensway. Minimum investment for our product is always $25,000, not increments of $25,000. So 26, 27. And what we do is we basically structure it in a way where it's RSP, TFSA, RESP, and LIRA eligible as well. So products are available for cash investment, corporations, holding companies. So there's a lot of ways to invest. 25 is the minimum. This product is about 6 3/4 timeline budgeted. And we usually look at about a 20% simple annualized return for most of our projects. It's essentially your cost of capital for this type of investment with this type of risk. So just an overview, it's pretty close to the Cineplex on the Queensway in Etobicoke, near the Mimico GO train station, relatively close to Bloor and Islington to the subway, and then just very accessible to major highways. We own the property adjacent to it, and we own the property at Kipling in the Queensway as well. And then we also owned a property that we sold to All Tree Developments that's pretty much getting completed now. So a lot of development in this corridor, not directly accessible to public transit, but people do need to live outside the city. And the urban core is definitely something where it will always be there, irrespective of where office space goes. But we're looking at kind of those external pockets of the GTA and, external to the downtown core where we can invest as well. So,
people are buying into a specific project and then staying with that for the lifetime of the project?
Correct.
Gotcha.
Yeah. So what we do is we're not a fund. So we do project by project investing. You can curtail your portfolio accordingly. And say, if I'm invested in high rise number 1, it's a 6-year deal budgeted. Maybe I want to do a low rise project in Hamilton. That's an 8-year deal because maybe I'll start getting my payout of this project in year 6 or year 7. So you're not getting a ton of money. If you're using your RSP, I guess it's kind of relatively locked away, but so you're able to kind of diversify your own portfolio with our team as well, based on your timelines, what products you like. And that usually creates the most competitive.
And can you do that within the minimum $25,000 investment, or it has to be minimum $25,000 within one specific LLP?
You got it. Yeah.
And just in terms of a timeline, just because that's a great example, one specific project we can probably all get our heads around. So when would you have first tried to acquire that land, and when would investors have gotten involved versus the developer itself gotten involved?
So I would say most of our projects are brought to. We usually underwrite about 200 deals a year, and underwrite means it'll come across our desk and we'll say, okay, this is interesting, or this doesn't support our thesis or what we want to do at this point in time. So of those 200, maybe we'll do actual due diligence on 60 projects, and then we'll actually put in money to doing due diligence for 20 projects, and then we'll do 6 in a calendar year, let's say 6 equity raises. What that is basically we're conditional based on due diligence, and then we go firm, and then we raise the money for the project. So it's usually between a 5 to 9 week span that we go to our investor base and we say, here's the project, there's an investor presentation, and then we raise the money for it, and then we close the project, and the project's off and running, and we go through whatever the project needs, approval processes. If it's approved, then we assess if we want to do pre-construction sales, and then we go about doing the project.
And would there ever be a scenario where you do all that due diligence, you do the investor raise, and then you don't close the project? Or
No.
Okay, so you're going to close it, and you know you have the ability to close it.
Yeah, exactly. Yeah, so you're We'll usually raise the funds, and then there's like a month period where we close, like we do closing logistics of the actual fundraising, and then we close the deal, maybe close on the property maybe a month later.
But it's your option to close the property. It's never the landowner's option.
Yeah, exactly. Similar to you buying a house, right? If you put in the offer, if they accept the offer, then you're in. Some of the project, like this project specifically on the Queensway, we bought it off of Sobeys, and we were in discussions buying it for 2 years. So some projects come through really quickly. Some projects, take a long time to negotiate or whatever it is. So.
And because you don't have investors at that point when you're doing that 2-year due diligence, how does that get funded? Is that just from Greybrook's general pool, or how
so we have about 8,500 investors active. So there's a big investor base there. And then we just kind of, when we have an active deal, we go out to our investor base or, potential prospects and do all that kind of stuff and raise the capital in that way. But it is, we always joke, it's a very difficult business to recreate because this deal's $40 million. To raise $40 million from essentially people you have in your investor base. It's not easy, but if you've built a reputation and investor base that's committed to your product, we do typically have a lot of interest for this type of product. So even though it's long term, 6 to 8 to 10 year deals, sometimes they're in the 4 to 5 year range. But people look towards kind of tucking funds away for a long period of time, and it's good because it's tangible. You can drive by it. It seems a little bit more of a product that you can invest in versus a REIT where you're kind of just buying into the REIT and they're allocating those funds accordingly. So it is an interesting, tough to recreate type of model.
How are those returns paid out? You mentioned this project is almost 7 years. Yeah. So is it on year 7 you get your full return, or is it paid out in dividends?
Yeah. So some people, the first question people ask is, when do I get my annual distribution? It's very much not that type of product. It's long term. It's a new development, so there's no distribution to be made. But what you do is essentially, if we're selling a condo like this, say we're selling one condo, you typically get majority of your distribution back in 1 to 2 to 3 balloon payments. It's never really one payment. Like for this Stockyards project that we have in the Junction, what we do is we pre-sell 60 to 70% of the units. And then using that pre-construction deposit, we then can secure construction financing. Then we build the site. Then maybe we'll sell a couple of units once it's kind of built, and then we'll hold back maybe 10, 15 units, let's say, depending on how big the site is, and we'll stage those and sell them to end users. So you're realizing a larger revenue. Maybe you sold a pre-construction at $1,000 a foot, and now you're selling them at $1,200 a foot. So strategically you're holding those back. Maybe it takes you, after the condo gets registered, it takes you 3 to 4 months to sell those units, but you're realizing a larger revenue. And that's just kind of the structure. So you might get your initial capital back, your $25,000, and then maybe you'll get another $10,000 a month later, and then we'll hold back funds for carry-on warranties, which is a small amount. So it really depends. Low-rise projects are different because maybe we bought 50 acres. It's a 4-phase project, so we'll start selling phase 1, and then we start selling phase 2, and then once we're starting to build phase 1 and phase 2, we'll start selling phase 3 and phase 4. So a 9-year deal you might end up getting your initial capital back in year 6.
But you average about 20% per year, but it's a balloon payments at the end.
Correct, yeah.
But that's kind of the Greybrook average across projects?
Typically, yeah.
So if you don't need your money,
I love the idea too of the diversification of some low rise, some high rise.
Yeah, and that's what we try to do. Like a lot of people, maybe you own a duplex in St. Catharines and you own your home in a single family home in Toronto or whatever you have. A lot of people are like, I want to do multiple condos and they only want to do condo projects. And there's nothing wrong with a condo project, but a luxury high-rise in Yorkville is treated completely different from a market perspective than a low-rise site in Whitby. Mm-hmm. Like the same person it's not the same person. The person that's buying that luxury high-rise is probably less prone to interest rate increases because maybe they're buying it in all cash. And then the person that's buying a starter home, townhouse in Whitby, they're more susceptible to interest rate increases. So if you're layered across multiple different projects, it kind of gives you that diversification, similar to any sort of stock portfolio.
Did you have trouble in the last couple of years when material costs and labor costs escalated so much? Were there how much haywire has that created for you?
It's a good question. Every project's a snowflake. Like, they're very, very, very different. So I would say, to make one kind of statement across the board, across like 60 or 70 active projects, I wouldn't be able to say if 20% per year increases in cost did not erode some of the returns in some of the projects. Some of the projects have seen substantial increases because the price per square foot in some of the low-rise projects that we've done external to the city have been hot products. But across the board, like, I wouldn't be able to say. There's still margin there, so a lot of our projects are doing well, and that's the benefit of having an execution partner, not just with us, but with a developer partner, and being able to access trades at a competitive rate and bank financing at a competitive rate. So during those times, you want to be associated with people that kind of know what they're doing. Yeah.
We've been talking, we've done a few webinars recently for clients talking about buying a second property, maybe buying a condo, taking equity out of their existing property. But when we heard about, your organization, and there's a few others, but that offer this type of opportunity to really still put your money in real estate, it really is a great option. I mean, we felt like, how do we not know about this for all these years? And I guess it's largely, I'm taking from what you're saying, is it's largely sort of, you have an investor group, they talk about you, and it's sort of more word of mouth growth versus, because you don't really market per se. Is that correct?
Yeah. So we're an exempt market product, so we're governed heavily under the Ontario Securities Commission. So we take it fairly seriously, not to say that other companies don't, but we don't market and blast out all of our information because one, you need to qualify for this type of investment based on your income and your financial assets. So that's for one. And two, we don't really need to, based on our reputation and our brand as to what we've done in the past. But from an investment perspective, it is an interesting way we've come through in the last 20 years. So Greybrook started as a family office for a gentleman that was in the healthcare industry, and he hired our two CEOs that are active right now. So they're the three partners of Greybrook. So, and then it just essentially rolled organically from family and friends to more and more people that wanted to invest in this type of product, and then partnering with developers, that kind of just came organically as well. And those partnerships they joke about it, it's like a marriage. Right. It's very much not like where you're just reporting to each other and then you're not connected. Like, they're very much 10 to 14 to 15 projects with the same developer partner. You're merged in the joint venture, so you're aware of like who's in it, who's leading the team, and all that kind of stuff. So that helps in getting projects done, and because it's communication in the end too, right?
Right. That qualification process that you just touched on, could you just talk a little bit more about that?
Sure.
Like, who can actually do these investments?
Sure. So typically for this type of investment in the past in private equity, it was reserved for high net worth people. So, which is unfortunate, because high net worth people, it's usually like money makes money, but our product, you're able to allocate capital even if you're not an ultra high net worth person, which is great. So our product is reserved for accredited or eligible investors. Accredited is typically higher net worth people, but so I'll go off of eligible. Eligible is $75,000 in pre-tax income or $150,000 in household income. So you and your spouse, if you live with your sister, it doesn't count as a household. So that's essentially the qualification, or $400,000 in net investable assets. So what that is basically all the equity you have other than the equity in your home. So that's the qualification. And then there's a suitability test, which I won't go over here, but it's basically my job as a representative of Greybrook to determine if this investment is right for you from a time perspective and a risk perspective, if it's something that you should be getting into. Maybe if you're 80 years old, you don't want to be getting into a 15-year low-rise project unless it's part of estate planning or, for the next generation, which it does happen a lot with us. But we need to have that discussion, and I'm always happy to have those discussions with people.
And does that income requirement go up depending on how much you want to invest? Like the 25,000 is a start, and then you...
Sure, yeah. So the 25,000 is... and it just goes based off the suitability test. So like if you were to say I had 500,000 in my RSP, I wouldn't let you do 400,000 in one project, because from a risk and a diversification, that wouldn't make sense and we would never allow somebody to do that. So it's just kind of seeing what's your plan from a family perspective, and then catering your investments accordingly. And you have the ability, if it's project by project, to invest in a 5-year deal or a 6-year or 7-year, to kind of cater your timelines depending on what's going on in your life as well.
So your Queensway project, which you've mentioned to us now, that one is done. You've got all your financing for that at this point, all your investors. What have you got coming next that we can sort of maybe share with our clients, give them advance notice?
So I typically don't say specific projects, because they're always, unless we have our internal discussion, we don't tell people, because then they'll hold us to it and say, hey, like you have this investment, and you told me about it. I liquidated my Apple stock because I was waiting for it. So not to say that's just an example, but so that's the reason as to why we don't tell people like what's in the pipeline. There's a ton of stuff in the pipeline. It's just, does it come through? But we look at, we're looking at some low-rise sites in the GTA, Greater Golden Horseshoe, some land development stuff, which will essentially be you buy the site, get it approved, and sell it to another developer, which are a little bit shorter. Or we'll do kind of a low-rise site, which is the whole approvals and the build and sales. So we'll have some of that this year. We're looking at some US stuff as well, in the high-rise, multifamily, and low-rise space, which should be interesting.
And are there any fees to set up the investment, management, any?
Sure.
Of that?
Yeah. So with regards to our investment, the underwritten return, or the estimated return, is net of a management fee that we take. So typically the profit split and how it works is the LP, or the investors in Greybrook, will have 85% of the equity to buy the site and do the soft costs and all that kind of stuff. And then the developer partner will put in 15, 20%. The profit split sometimes is like 55 for the LP, 40 for the developer partner, and then 5 for Greybrook, or 10 for Greybrook as a management fee. Your 20% return, or whatever the return profile for that project, is net of that profit split. The only fee associated with the actual project is if you're investing in your RSP or TFSA, you need to open an account at Olympia Trust. Olympia Trust is a custodian that holds registered funds, which is essentially mandatory for you to invest in RSP. The fee for Olympia Trust is $150 plus tax per year, and you need to hold that account open for the duration of the project. Then you can close the account, but that's essentially the only fee associated with the project.
Excellent. Well, thank you so much for sharing all of this
Yeah.
with us. It's great
pleasure.
learning, and so exciting to know about a different way to invest in real estate. So we'll have all your information, and if anyone's interested, we'll definitely get them in touch with you to learn more.
Perfect.
Thank you.
And have me back, because
Yeah,
I love Don Mills.
Next year.
What a place.
Excellent.
Thanks so much.
Thanks,
Thank
Alex.
you.
It's great.
Thank you. Yeah, thanks.